Why is the global oil market shifting gears right now? Today, July 6, 2026, the energy world is reacting to a significant move by OPEC Plus as the alliance has approved an increase in oil output for the fifth consecutive month. This isn't just a minor adjustment, it is a strategic response to the reopening of the Strait of Hormuz, one of the world's most critical maritime choke points. As traffic begins to flow normally again, the artificial scarcity that previously drove prices up is evaporating, leading to an immediate slide in crude costs. The catalyst for this decision is the recovery of exports through the Strait of Hormuz. For months, geopolitical tensions created a bottleneck, threatening the flow of millions of barrels per day. However, recent reports from the Wall Street Journal and other major outlets confirm that traffic is now recovering. This recovery allows OPEC Plus and its allies to pump harder, knowing that the logistics of delivery are no longer the primary constraint. The ability to move more oil through this narrow waterway is the direct reason we are seeing this fifth straight monthly hike in production. The market's reaction has been swift and bearish. As news of the production hike broke today, oil prices began to fall. According to reports from Investing Live and Commonwealth Bank, the anticipation of increased supply is outweighing demand forecasts, putting downward pressure on crude benchmarks. For traders and consumers, this means a shift from a period of scarcity to one of abundance. The EMEA morning briefings highlight that this output expansion is directly correlating with the price slide we are observing across global exchanges this Monday morning. But there is a catch. This increase in output is happening against the backdrop of what analysts describe as an uneasy truce between the United States and Iran. The stability of the Strait of Hormuz is currently tied to this fragile diplomatic balance. While the production hike for August is approved, the market remains nervous. Any breakdown in this truce could instantly reverse the recovery and send prices skyrocketing again. The current output increase is a gamble that the diplomatic peace will hold long enough to stabilize global energy costs. Looking ahead, the focus remains on August. With the fifth consecutive hike now locked in, the immediate trend is towards lower prices, provided the shipping lanes remain open. If OPEC Plus continues this trajectory, we could see a sustained period of lower energy costs, which may help cool inflation in several major economies. However, the volatility remains high because the supply is now heavily dependent on the continued stability of the Hormuz region rather than just production capacity. The takeaway for today is clear. The reopening of the Strait of Hormuz has unlocked the supply chain, allowing OPEC Plus to pump more oil and driving prices down. While this is good news for consumers and transport costs, the fragility of the US-Iran truce means the market is still walking a tightrope. Keep a close eye on the shipping traffic in the Gulf, as that is where the real story of oil's price movement will be written this summer.